The Bank of Canada has announced a quarter-point increase in its main interest rate, bringing it to a new 22-year high. The bank also stated that achieving its 2% inflation target would require more time than initially planned, due to ongoing strong consumer spending. The bank increased its target for the overnight rate from 4.75% to 5.0%. This follows an unexpected quarter-point hike in June. A recent survey of economists by the Wall Street Journal indicated that most anticipated this further increase, pointing to stronger than expected economic growth. These consecutive rate hikes mark a significant shift in the strategy of Canada's central bank, which had previously paused its tightening policy in January, believing that a series of quick, steep increases in borrowing costs would control inflation and maintain employment levels throughout the year. The Bank of Canada's governor, Tiff Macklem, stated that the bank is willing to implement further interest rate hikes if inflation does not decrease as projected. He said that each decision will be taken individually, based on the most up-to-date information available. Before making the decision to increase rates, senior officials at the bank considered maintaining current rates and waiting for more data. Ultimately, they agreed that interest rates needed to rise, stating that the cost of delaying action exceeded the benefit of waiting. The central bank's statement explaining the rate decision, accompanied by an economic forecast, suggested that the downward pressure on inflation might be stagnating. This decision comes in the context of households maintaining steady spending on goods and services, supported by a strong labor market, population growth due to immigration, and savings accumulated during the COVID-19 pandemic. In the first quarter, Canada recorded the fastest economic growth among the group of 7 economies, at an annual rate of 3.1%, exceeding the central bank's prediction of a 2.3% expansion. The Bank of Canada aims to achieve and maintain 2% inflation with its interest rate policy. The bank now expects inflation to reach this target by mid-2025, 6 months later than it had previously predicted. It anticipates that inflation will remain around 3% for the next year. The central bank noted that while inflation has substantially decreased from a peak of 8.1% in June 2022, this was largely due to lower energy prices. Short-term measures of core inflation, which exclude fluctuating items such as energy and food, have stayed between 3.5% and 4% for about 9 months. According to a recent survey of executives, businesses plan to increase their prices more often than usual. Senior Bank of Canada officials have expressed concerns that progress towards the 2% inflation target could stall, putting price stability at risk. Charles Estiarno, an economist at Credit Union Central of Alberta, interpreted the central bank's communication as leaning slightly towards further tightening. He noted that if there were a balance to be struck between economic activity and fighting inflation, the Bank of Canada would prioritize combating inflation. Despite an increase in Canada's unemployment rate to 5.4% in June from 5% in April, Macklem noted that the unemployment rate remains historically low. He said that the current pace of annual wage growth, between 4% and 5%, needs to slow down further to help achieve the 2% inflation target. The central bank expects economic activity to decelerate, although recent data on retail sales and other indicators suggest a persistent excess demand in the economy. It predicts annualized economic growth of 1.5% in the second quarter, higher than its previous estimate of 1%, followed by an average growth of 1% through the latter half of this year and the first half of 2024. This is due to higher interest rates reducing the after-tax income available to households. The bank also anticipates that growth from exports will decline as higher interest rates in other countries, particularly the United States, come into effect and reduce global demand. Later this month, the Federal Reserve is expected to increase rates following a pause in June.